Thank you, everyone, for joining us today. We know your time is your most precious resource, so we will try hard to make good use of it. We have gotten a lot of questions submitted in advance, and if you have questions on the call, please submit them because we really do want to make this the most useful to you. I also just want to thank the team. A lot of work goes into these webinars and our quarters, and it's a team effort, so thank you so much to the team. Uh, if we can put up the slides. So I will just spend a couple minutes, you can go to the next one, Christy, on Patient. Most people on this call know who we are, but I started Patient in 2020 as part of Miller Value Partners, where I worked with Bill Miller for many, many years. When Bill decided to retire, Patient took over the Opportunity Trust business that we had co-managed together for many years. So the entire team that had supported both products, the investment team, the operations team, became a part of Patient, and we became fully independent in 2023. So we're going on 3 years as an independent company. I think the most important thing to understand about Patient is that the philosophy and process that we follow really started, over 40 years ago with Bill and his partner Ernie Keeney at Legg Mason, and it's been continually refined and evolved since then. And I really think that's our secret sauce. I have a ton of conviction in our philosophy and process. I think it's unique in this environment. Not many people operate the way we do, and I have a lot of conviction in it. And some of the best minds in the business, like Bill and Michael Mauboussin, were architects of this process. So I'll go into a little more about that here on the next slide, which is we are value managers. We get this question a lot. We got it again today. We are valuing businesses. We're doing a lot of in-depth valuation work. We take a long-term perspective, but over time, market prices follow the fundamentals of businesses. And so look, we're comparing those fundamental business values to the market expectations, and we're looking for gaps where the market's getting something wrong, and the market is very good, extremely hard to beat. We have a ton of respect for the market. So we're always trying to think about what is it that the market's getting wrong? What is our edge? The most enduring edge and the one that we most often find is a behavioral edge where, we're just not wired either at an individual level or an institutional level to have sort of optimal investment behavior, to think probabilistically, to be long-term, to not let our emotions rule us. But most of the time, the market gets it right. And most of the time when we're doing our work, we say, wow, this is probably the easiest base case analysis on this company. And then we want a diversified set of holdings, within the portfolio. You can go on to the next slide. The other thing to understand about us is that we think flexibility is a huge asset and advantage. And Bill explicitly designed the Opportunity Trust to have the maximum flexibility possible. So it's not constrained by market cap. It's not constrained by security type. We do mostly equities, but we can go anywhere, and what guides us is where are the best opportunities in the market. And so we will do unique things, like we'll invest in, derivatives, like long-term options. Again, sometimes, over the past decade, there's been great opportunities there. That's been less so lately in a more optimistic market. We'll do PIPEs, which are private investments in public equities. We did one with QXO a couple years ago. We led a deal with Precigen, which was a strong contributor to our 2025 returns. So we're looking anywhere we can to deliver market returns. We're also, highly aligned with our investors. I think this is so important. I think any fund you invest in, you should look at how much do the portfolio managers and the analysts have invested alongside you. The majority of my liquid net worth is in our funds. I started a long-term incentive program for the analysts where a significant portion of their bonus goes into this plan that vests in 5 years only if we outperform the market. So, and they all have, personal investments in the funds as well. So we are significantly aligned. We're managing the portfolio in a way that we want to buy, that we think is the most attractive way to manage your wealth, not that we want to sell to other people because they want to buy it. And then, we've always tried to be tax efficient. ETFs have been, getting a lot of flows. They're very attractive to many people. A couple of the reasons for that are low costs and the tax efficiency. And we're always trying to make sure that we can deliver any benefits we can through the structures that we have. And so we've always been tax efficient, but we've found new ways to mimic what those ETFs are doing. And I'll let Christy spend a few moments on that since she was the lead on those efforts.
One thing we realized as we've done more work on what an ETF structure looks like is that there's hidden costs in terms of transaction disparities. And so you can't control limits, you can't control spreads in terms of what you're trading in an ETF wrapper. And particularly in some of the smaller cap or less liquid names, managers can be really hurt by that. And that's just how an ETF functions. There's no way around that. So from our perspective, we manage those things very tightly. We track them very closely. We try to be as efficient in terms of our trading costs and execution price as possible. And then now we can layer on the benefits of trading tax efficiently. So we think we're really kind of narrowing the gap as much as we can to the differences between what an ETF wrapper looks like.
And now on to our market views, which I'm sure, is what many people tune in for, although I feel like a broken record here because it's the same story that it has been. Our views on the market don't change every quarter. There's lots of headlines and lots of news, but really the fundamental signal, I think, is that, the secular bull market that started in March of 2009 is continuing. And this has been one of the longest, strongest bull markets on record in history. The S&P has annualized returns over the period at close to 17% a year. So that's extremely high, much higher than, the long-term average in the S&P of just shy of 10%. And that's because we started from extremes in pessimism. People thought the world was ending at the worst point and that the financial system wasn't going to make it. But even after the recovery, you had people like PIMCO out talking about the new normal and the lost decade for stocks because economic growth was going to be subpar because it usually is after financial crises. So they were wrong about that. And valuations were quite low then, although you had a lot of valuation concerns. The Shiller PE that people still trot out was used even at the lows in the market to signify, that it was overvalued. So that is about the worst signal I've ever seen in the history of markets. So it's shocking to me that people still use it, but they do use it. But we've managed to do well over this period, and that's been particularly attractive given that, value overall has lagged. And so its annualized returns, as denoted by the S&P value, which does have stocks like Microsoft and Amazon, so we do think it's a fair comparison, has been up 14.8% a year. We are, I believe, in the later stages of the secular bull market, but it could continue to last for a while, and the latest stages are sometimes have some of the best returns. And so I think the late 90s is probably the best comparable period because it was the later stages of a secular bull market as well that started in 1982, and it was a technological revolution, then the internet, now AI. Now I hold all these comparisons very, very lightly and put, you monitor it, you observe it, and I wouldn't bet the farm on this, but it does appear to me to have many similarities to that period. In the late 90s, we had 5 consecutive years of 20+% S&P returns. So over the 5-year period, the S&P was up 250%, and it compounded at 28.5%. I mean, those are astounding returns. So it's been a little bit lower. So for the 3-year period in 2025, as Rebecca said, the S&P was up just shy of 18%. So we are a little bit lower. We have not even had 3 years of 20% plus returns, but the 3-year compound rate is 23%, which is still, quite strong. Overall, you can go on to the next one. And I think, we monitor, a number of key indicators on the market. As I said, at the top, the S&P performance has been quite strong. That's been driven by strong, underlying economic growth. People were expecting a recession. So lots of stocks were priced for a recession in 2022. We had a lot of cyclical, value type names that we thought fully discounted a recession. And we thought it was, a great opportunity, although it could have gotten worse before getting better if you'd had a recession. Coming into 2023, Wall Street strategists were expecting a down market. That almost never happens. They stayed pretty bearish and thought the market would be flat in 2024. It was up 25%. Their views always just follow the stock market. So as the stock market has done quite well, their views have become rosier. And for 2025, and then for this year, those strategists are expecting low double-digit returns. Corporate earnings growth has been extremely strong. And so in 2024, it was up close to 10%. In 2025, it looks like that'll be close to 12. And, bottoms up estimates are calling for close to 14% in 2026. So very strong and accelerating growth overall. Now it's a higher bogey in 2026 with 13.6% estimated growth. But even if we fall a little bit shy of that and those estimates come down, if you're still getting double-digit earnings growth, I think that's highly conducive to a strong market. So, if you look also, expectations obviously are much higher now after these strong markets than they were at, the beginning in late 22 or 23 or 24, but they look roughly comparable to where they were at the start of last year. So the Citigroup Panic Greed Index was registering greed. It's still registering greed. Barron's Roundtable finally just turned bullish for the first time since, I don't know if they were bullish in 2021, but they weren't in 22, 23, 24, 25. We're having record fund flows. Valuations, people have a lot of concern about that. I will get into that. They're at, they were starting the year at 22.1 times, but that was only a little higher than where they started 2025. So you didn't get much valuation expansion last year, which again, I think is a good thing. And I think it speaks to some of the concerns in the market, which again, if those continue, would extend the bull market. Chris, you can go into the next page. Our favorite chart or quote by Sir John Templeton: bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So as I said, expectations have risen. Maybe we're somewhere in the optimistic camp, but we have pockets of euphoria and pockets of skepticism. So if you look at stocks like the quantum stocks or the nuclear stocks, these stocks trade at, either in infinite times revenues because they have no revenues, or some have a little bit of revenues, so they might be a couple hundred times revenues, and there's a big belief state about a rosy future. Again, some of those areas look quite expensive to us, but you still have, significant skepticism, I would say, in certain areas of the market. This AI bubble concern lingers. I think that's, actually a great thing because it helps keep a lid on valuation. So coming into the year, you still had Meta trading at a sub-market multiple. NVIDIA wasn't much higher than a market multiple, despite growing, 60% plus, and again, accelerating growth. You normally don't see valuations like that. So the tech bubble experience and probably the financial crisis too scarred a generation of investors, and that's helping, keep a lid on expectations, which I think will help sustain this. You have strong GDP growth. GDP now is forecasting over 5% growth in the fourth quarter. You had a record number of repurchase announcements in 2025, $1.4 trillion, so that was 2.3% of the market cap of the market. The Fed's cutting rates. All of that is conducive to a continued bull market. So you do have valuations at the high end of the historical range. So that would be, one of the top concerns is usually over longer periods of time, that, weighs on growth. Although, as you see here, over 1 year, it has, you may not be able to see this, but the R squared, this just looks at historical multiple levels versus forward returns. And on a 1 year basis, the R squared, which is how much these things correlate, is virtually zero, meaning it doesn't really matter. It's not a significant driver in the short term, 1 year. Over 5 years, it matters a little more, 0.25. So it explains, 25% of the returns. That's still low overall. Over a 10-year basis is much more material and explains, 75% of returns. And historically, when we've been in the low 20s, the forward 10-year look has not been great. But again, there's only a handful of these instances, and many of them were from the tech bubble. And if you look now, the justified multiple on the market is actually significantly higher than then because the returns on capital and returns on equity are higher. The free cash flow generation is higher. The free cash flow margins are higher. The growth has been high lately. Obviously that will matter, where that comes in over the long term. But it looks to us like the market's roughly fairly valued, maybe a tiny bit above fair value. But again, there's a wide dispersion within that overall. That might be the next slide. Yeah. So there's a wide dispersion. So you can see here that the median multiple in the market at 18.8 times is above the long-term average of 16.3, but it's only 15% above. And if you look at the top end of the line, the gray bars, the gray shaded area shows, the highest valued companies in the market versus the lowest valued. So at that high end, those, most expensive companies, they are at the highs that we've seen historically outside of 2021. It's close, to 99, 2000. At the low end, the low end, the value stocks really aren't any higher than they've historically been. It's been a terrible market for value strategies, and managers have had to go out of business unless they've adapted their approach, more in line with tech and growth and all the things that have been, going well. I think this wide dispersion, though, creates a good environment for stock pickers, especially value stock pickers. And for us, there are always areas of the market that, for whatever reason, most of the time, short-term reason, are under pressure or out of favor. And so that tends to be where we gravitate and where we look for opportunities. And, many people in the market don't want to be early. We continue to like providing liquidity, and we'll be patient for those values to converge. And if we have confidence in the fundamentals and the strength of fundamentals, they will converge. And it usually doesn't take that long. It's when we make some error or mistake on assessing those fundamentals that we run, into problems. You can go to the next slide. So one example of that we have talked about, was healthcare. And healthcare is a way that we built up, as of the end of the year, it was 27.6% of the portfolio. So a significant weight. The S&P's weight is 9.6. So, again, we are benchmark agnostic, and we're just looking for the best returns in the market. And we saw a lot of those here in healthcare. It got to 50-year relative valuation lows. So, that's extreme. And so in that environment, we were finding lots of opportunities. Now, in the fourth quarter, it did well and, rebounded late in the year. You can barely see that on this chart here. This is updated through last week. It's barely a blip. And so, we think this exposure in the portfolio, these companies that we own, we think have very attractive returns, and they're non-cyclical and provide, a good amount of resilience that we think, will help the portfolio perform better if the market runs into challenges too, which we aren't expecting, although we would expect a pullback this year. You have those almost every year. In terms of the portfolio, before we get into questions, just a few comments on that and some stock ideas. As Rebecca said, performance has been very strong. We've been very fortunate about that. We've been helped by a very strong market. So since I took over sole management at the end of 2022, the S&P's up 23% a year over the past 3 years. So that's a great environment. I got lucky to start my sole management at that time. For 2025, if we look at, the contributors and detractors to performance in the portfolio on the bottom, you'll see the full year period. The biggest contributor to our performance was Precigen. If you look at all three of the securities, we did that private deal with them in December of 2024. This is a company that we've known and owned for a long, long time. I thought Helen Sabzevari, the CEO there, was excellent. She really drove results through the clinic during COVID when other companies really struggled. They had their first, approval coming up in August of last year, 2025. They had a bad balance sheet. The company was small enough that we could help solve that problem. And so, the market was discounting bankruptcy, and, we saw a path to its first drug approval and commercialization, free cash flow break even with a strong pipeline behind it. So we structured a deal in line with Warren Buffett's historical deals with a preferred with an 8% coupon and warrants. And that worked out extremely well. As I said, it was over 800 basis points contribution to 2025 returns. Other contributors were Alphabet, Citigroup. So one compounder, one classic value. We were, adding to both of those when they were very out of favor, and they've worked out well. And we continue to like both of those names. On the detractors, some of our biggest detractors were New Fortress Energy and Cosmos. Both of those have very high expected values. They both had bad balance sheets and were priced for distress. We saw a path for them to work out of that, but unfortunately, both of those companies, had fundamentals that significantly disappointed us. And so when companies are disappointing us on the fundamentals, not the price, when the price is weak and the fundamentals are good, that's an opportunity, or at least when the fundamentals aren't disappointing us, they're in line with expectations. But unfortunately, those companies both, really underperformed our expectations on fundamentals. So we exited those. Other detractors, Dave & Buster's, Fiserv, Crocs, we're adding to many of those names, and I will, go into more details in that shortly. On the quarter, the contributors and detractors were comparable names as well. We saw a big momentum move in the market last year, and especially into the fourth quarter. The portfolio trades at 15 times earnings, which is 1/3 cheaper than the market's 22.6 on, a comparable basis with higher than expected growth. So if that's right, that should set the portfolio up to do well. I would point out that we've been aggressively redeploying, some of the names into underperformers. So some of the names that got closer to our assessment of what they're worth, like in the cyclical value area, they did extremely well late last year. So we were selling some of those names and redeploying into others that had underperformed. And we still do have a very diversified portfolio with 44% in what we call attractively valued compounders like Amazon and Alphabet and Royalty Pharma, although Royalty Pharma could go in the classic value bucket. So some of these can fit in a number of buckets. We have 13% of the portfolio in what we call early stage companies and 49% in classic value. And I'll go through just a few names that we think are very attractive in here, one from each of those buckets. So on Crocs, this is a classic value name. We've owned it for a while. It's been under pressure. We've been adding to it recently. It's down almost 50%. It was at the lows earlier in the week, down 50% from its 2024 high. Tariffs were a headwind last year. It's Hey Dude. It bought Hey Dude a few years ago. We thought at the time that was a mistake, and the performance of Hey Dude has been terrible, and we think it will not be good in the fourth quarter, but we think it's bottoming, over the course of 2026. This company generates a lot of free cash flow. I think the children's business is consumer staple-like. I have to buy these shoes for my kids every, 6 months because they love them and they wear them every day. It has a 15% free cash flow yield, trades at 7 times earnings. The market's discounting no growth. They have a great team here. In particular, Terrence Riley is the chief brand officer. He turned around Crocs brand in the past and Stanley the thermoses that, used to be when I was growing up, construction workers used them. And then, as a few years ago, my daughter and her teen friends, they were all the rage and used by them. So he knows what he's doing in this space. They have Sydney Sweeney as a brand representative. I just read an article on Bloomberg today that they have this new $150 Lego Croc that special edition. I don't know who would wear this stuff, but people out there do like it. But again, I just think you have a free option on a turnaround. And with where Hey Dude is now, and with Terrence Riley, I think there's a lot of things that could go right for this business that are not priced in at all. And they're using all their cash flow almost to buy back stock. And so the company shrunk shares outstanding by 14% over the past 2 years, 9% over the past year. That should put a good floor under the stock as well. So we think this one's worth double the current price. Amazon is a name that we've owned. It predates me, but we still think it's extremely attractive. And I get questions a lot on what possibly could be our variant perception on Amazon. How could we possibly know anything others don't know? Well, it's not that we know anything other people don't know, because that's an information advantage. But I do think we have a behavioral advantage here, which is, classic time arbitrage. People are, the market's very short-term oriented. So I think Amazon has probably the longest duration growth profile of any company in the market, and you're not paying for that. So Andy Jassy is an excellent CEO. Since he came in 2021, when he came in, operating margins were 5%, a little over 5%. This year, they'll be a little over 11%. So they've more than doubled under his tenure. He's much more aggressive about, making sure each business has a path to profitability and is executing against that path. There's still, Jeff Bezos built this company to innovate at scale. And so they are still doing that. Jassy talks about it every letter, every time he speaks. They're still investing. They're investing in, low Earth orbit satellites and healthcare and grocery. No one gives them any credit for those, because until they have, some economics there, it can be hard to estimate the value. You see here some of the parts, by one sell side analyst that I think is reasonably good on what they do value, which is, has it worth $335. The stock, when we put the slide together, was trading at 230. Today it's 234. Again, none of these analysts, or very few, I've seen one report on trying to estimate the value of the low Earth orbit satellites. Nothing on healthcare, because it's so early that it's hard to make assumptions about what that might look like. But we think, that those businesses, healthcare, low Earth orbit satellites, grocery, are easily worth at least $15 a share right now, and that could grow a lot over time. So you can get to 350. So that's 50% upside. You normally don't see that much upside on a present value basis for such a strong, durable company. They are investing a lot, as are all the hyperscalers and people going after AI. So their CapEx is high. That should normalize over some period of time. Here we have a look at if it normalizes over 5 years. One thing we know about this company is they're extremely rational. So they're only going to keep spending if they can pencil the returns. And when you talk to Andy Jassy, he says, if they're making the wrong decision on how much to spend, he's worried that they're not spending enough, because they have the demand right now in the business. So it is not like the internet where they were build it, they will come. Like, these cloud providers have the demand right now for this. And there are constraints on how quickly, they can build. So that is a fundamentally different supply-demand picture. And I think Amazon underperformed last year. I'd be very surprised if it underperformed again this year. When I looked yesterday, there were only 2 of the Mag 7 companies outperforming, or I guess it was, Tuesday, and that was Alphabet and Amazon. So I think Amazon's probably set up for a good year this year, and on a longer term basis. And then the last one is Coinbase, which we've owned for a long time. It is a volatile stock. We would expect that one to continue to be volatile. We think it's very early in the evolution. You just had the Genius Act. The Clarity Act has run into some challenges in the short term. There's still a lot of will to get that across the finish line, but we're just getting regulations, that enable this industry to really go after the business. After we got the Genius Act, there were 200 announcements of companies and, their stablecoin offerings or efforts. So I think there's a lot of demand. There's a lot of interest. I think Coinbase is, the platform here. They did 9 of the 11 Bitcoin ETFs. They already have partnerships with 5 of the top 20 banks to power, their crypto infrastructure. It's down 50% from the highs. The price continued down a little more. So, current levels, it was down 50% from the highs. That's a good pullback in the same. We think over the long term here, these estimates are conservative, if anything. And, as Bill, we don't want to be conservative, as Bill said, we want to be right. And we do want to be right with companies that are very early stage and volatile. It can be more challenging to, to know exactly how the fundamentals evolve. But I don't think you need to believe much at these sort of levels. So we think the stock is worth $400. It's trading in the low 220s. And this is one that I think you could just put away for a decade. It'll be volatile on the path there. But I think it has strong competitive advantages, likely to do very well over the next decade.
Thanks for that, Sam. So as Rebecca mentioned, we are trying to take live calls as well as a bunch of calls that were written in beforehand. So we will try to get through as many as we can. Any questions we cannot get to live, we will follow up with answers to those questions afterwards. So send those along. So Sam, one of the questions that we got, which I'm sure are on a lot of people's mind, as we look ahead, where are you seeing the most compelling investment opportunities?
Yeah, so I mean, as I said, I think the market's roughly fairly valued with wide dispersion. And so we're still finding lots of values. Some of the pockets are, easy to talk about, and some are more disparate. And I'll go into what I mean there. So like payments was a terrible performer in 2025. Every company in the space did terribly. And I think there are lots of interesting names in that area. We bought back Fiserv, which we had owned previously and sold over 200. We didn't think the risk reward was great at those levels. Then the CEO, Frank Bisignano, left and went and joined the administration. A new CEO came in. Then they started running into problems and it became apparent. So the stock was down a lot. We were early. That tends to happen to us, but that's okay because we, average in and but it came to light in the last quarter. I think they finally kind of admitted all of the errors and what was going on and really took the painful pill. They hadn't been quite honest about how much Argentina had helped their results, and they were playing these short-term earnings games, across the business to hit earnings, which is never a good thing. But the new CEO, Mike Lyons, is, now came clean to the market, lowered growth expectations. He's investing. He's stopping the short-term, quarterly, management of the business in that way to sort of game earnings. The stock's at 65. It was up today to 67. We think it's worth 135, so more than double the current price. They still have some great assets within the company, like Clover, which is a small and medium business payments, platform that is growing nicely in the double digits. The growth has slowed, but that's still, doing well. I think there are other interesting names, probably many names in the space, are quite interesting. We bought Chime, which is a new, IPO. So I think it's not well understood yet, but I like it because it's a low cost platform going after, the lower end consumer who don't have a lot of great options in banking because most banks aren't set up to serve them profitably. So they have, got a cost structure that's very low, that's set up to profitably serve these consumers. Most of their revenues are debit interchange revenues, so they do have some credit risk, but not a lot of credit risk. So I think there's a long-term opportunity for this company. They're just going to be, GAAP profitable over the course of the next year. When SoFi went GAAP profitable, it was great for the stock. I think it has a great management team. Some names that we don't own, like Global Payments, has a 20% free cash flow yield. Some good owners like Glenview. But I think many names in that space are interesting, and I still like a lot of the names that that we own. That like Amazon and Meta. Meta had a bad year last year. Again, it's trading for a sub-market multiple. People don't like the spending, but they can continue to cut costs elsewhere, which we've seen headlines come out for that. Mark Zuckerberg is a very savvy executive, and I do think it makes sense to invest to go after this, opportunity. We still like Norwegian cruise lines. I think it's misunderstood. People are worried about capacity in the Caribbean, so it's still trading at like 7 times earnings. So there's still a lot of names to like. If the market has some impression that there's some short-term problem in a business, it's not willing to look out to the longer term. So I think for investors like us that are long-term and contrarian, that creates a lot of opportunities.
Yeah, short-term dislocations definitely grab our attention. With that, I guess more long-term, like what keeps you up at night and what are the risks and uncertainties that you're spending time thinking about?
Well, it's funny because I think I said on the last call that I consider myself a paranoid optimist. So I think actually I get asked all the time, what's the difference between me and Bill? And this might be the best answer. I always, there's a bunch of different answers to that, but Bill is a pure optimist and he's not paranoid at all. And I'm a paranoid optimist, but I think, history and, being rational and factual, like you should be an optimist because markets mostly go up most of the time. You've made great money by being patient and long-term in markets, and things have generally worked out, especially in the U.S., and gotten better over time, although there's bumps, there's bumps in the road. But there's always a long list of worries, and some of them could be really bad, and so that's where the paranoia gets in. And I think I would say it's worse later in the bull market, but I remember when I started my own strategy in 2014, I was like, oh, of course we've had 3 good years, and we were number 1 in 2012, number 2 in 2013. So I'm like, oh, we're, like, this is not a good time. But it actually ended up being an excellent time to start because we were still quite early in the secular bull market, and it could still go on for, a lot longer. And you still read concerns all the time in the papers about all sorts of things. And, there are potential risks, and, they could cause negative outcomes. But every time we've had a negative outcome, in the U.S., we've worked through it, and over time things have done well. So I guess the biggest things I would worry about would be China invading Taiwan. That would be extremely bad and have very negative implications. That's like a terrible eventuality. Again, it looks like things between the U.S. and China have gotten better, not worse. So that's good news there. That doesn't seem imminent. The market will let you know, and the market's been very strong. So I think another thing that I think about is just the risk of long-term interest rates moving up. I think if we were to see the 10-year, go above 5%, that would be, highly problematic for the market. Again, interest rates recently have, not very recently, like in the past couple of weeks, they've been up, but over time, over a little bit longer time, they've actually been down, and the Fed is cutting rates. And with tariffs last year, the deficit actually, as a percent of GDP will come down year over year. So again, we'll see what happens this year with the one big, beautiful bill. But, in that scenario, I think, the more value oriented you are, the more you have near-term cash flows, the more protected, you'd be in that circumstance. And we have a lot of those kind of businesses. So again, mostly what we do is think about what the risks are, think about how things would behave, which is, it's not always easy. Sometimes things behave in ways that are very unexpected because it's a complex adaptive system, and try to construct the portfolio so that, we can do well in a variety of scenarios.
Well, you kind of hit on where I was going to lead you next. And, one of the questions we got is what would cause value to start consistently outperforming growth? And with that, also, what would help with small and mid cap since they've been laggards to the large cap arena for quite some time?
Yeah, well, it's interesting because value actually started outperforming in late October, and that coincided with the Fed rate cuts and one of their, decisions to continue cutting rates. So again, I think higher interest rates have been, have hindered some value companies that were more cyclically oriented. The tech, has just sort of powered through, and other areas of the economy have, some of them have had challenges, and then in other areas, it's more been the concern of the market that have weighed on valuations. So again, with Fed rate cuts, that's helped, and we've seen this broadening out, which if we continue to have, strong economic growth and there's more rate cuts expected this year, that could very well continue. I still think, some of the Mag 7, they're very attractive. I think many of them at these levels. They're not, I do think that they're the best companies in many cases that ever existed. I know, a lot of my active manager friends hate it when I say that, and value managers hate it, and because it's been a big headwind for, active managers. But I think it's, a tough bogey, especially for these names that have done poorly, more recently. But I think, what will give me a lot of confidence that on a secular basis, value will do better. I think that will happen in the next, at the end of the secular bull market. It could happen before then, but maybe it will, maybe it won't. Usually you don't have a change in leadership during, during a bull market. But I have a lot of conviction, and you saw at the low end of that chart that, the lowest value part of the names, and it's exactly how behavior works. People have thrown in the towel on value. People are, going to passive, which is, overweighting the highest market cap names in the market, which are, the large cap names are the most expensive relative to history. And so then no one will have that exposure right at the time that it's the most, attractive, and, the big long-term secular bull market for those kind of names, starts. Again, we pay attention to that. We look at those, the value of those names relative to other names in the market. I think on the small and mid, those have also started outperforming. I think today was the 14th consecutive session that they've outperformed large caps, and it's a lot of the similar stuff: Fed rate cuts, improvement in, economic growth. Goldman Sachs had a report that said that it thought that would continue for like the next 6 months, but not for the full year, because you still have this, the S&P growing earnings at a very strong rate, and these tech companies growing earnings at a very strong rate. And that's, it's difficult to, massively outperform and compete with that.
So I have a couple questions on everyone's favorite topic. You've hit a little bit on it, but AI is obviously what everyone's focused on. So I'm gonna list the 3 questions out. I can repeat them if you forget them, but they all kind of bleed together. So one is the level of spending getting out of control, and what percentage of the spend do you think will ultimately have a positive return on investment? Second, is all this spending the only thing preventing the economy from slipping into a recession? And then finally, are valuations across the ecosystem excessive?
Well, the spending is definitely high. It's very high levels of spending. I think the hyperscalers are estimated to spend $400 billion on CapEx in 2025, like 530 plus in 2026, and 600 plus in 2027. Gartner estimated that total AI spend globally was $1.5 trillion in 2025, going to $2 trillion in 2026. World GDP in 2025 is estimated at 117 trillion. So that spend would be about 1.3% of world GDP. So that's a lot of spend. It's very high, but is it out of control? I mean, what does that mean exactly? Or is it too high? Again, those are harder because it implies some correct level that is known, and obviously that doesn't exist. It depends, as the questioner said, on the ROI. If you look at during the railroad build out, I think the peak level of spend was 5 to 6% of GDP. In the late 90s, I think the peak build out, it depends how you measure it, but was like the incremental build out of the internet was like 4% of GDP. So we're still well below historical infrastructure build outs. And again, you have really, really smart people who think this is bigger than all of the historical ones. And so I don't think it's crazy in light of the potential here. How much of it will have a positive ROI? Well, there was just the New York Times, article, I think it was over the weekend, cited a Wharton study that said 3/4 of businesses are getting positive ROIs on their spend. And, this was in an article by Sebastian Malley, I think his name is, who's coming out with a new book, but he's a financial historian. And he noted how surprising and positive it is that this early in a cycle, we're seeing those results, because usually it takes much longer for the technology to diffuse and for people to figure out how to use it in a way that's positive ROI. So again, I think overall, it's not concerning. I think I would be much more concerned in certain areas of the private markets where I do think it's insane. So if you look at OpenAI, and I think his article was the one that said it was about why he thought OpenAI would run out of business and run out of money in 18 months, which I don't think will happen. But they raised $40 billion in March of 2025, and now they're rumored to be in the Middle East raising another 50 billion less than a year later, at an $800 billion valuation. So again, the private markets are funding this, but these valuations, they're not going to be 50 baggers, it's not like when they were funding smaller companies. But just to put those numbers in context, which this article went through, that is the largest private, the 40 billion was the largest private fundraise ever. The second was Ant Group, which raised 15 billion, so much lower. And that 40 billion is larger than any amount raised in an IPO as well, because Saudi Aramco had the largest IPO and they raised 30 billion in 2019, and both those companies were highly profitable. So, OpenAI is burning tons of cash, and it will burn, its own projections say it'll burn much more cash, 45 billion in 2028. And so again, that's, yes. And I think Brett Taylor, who's the chairman of OpenAI now, was on at Davos saying there was, bubble-like behavior. And I think there is in the private markets. And there's this, skew aspect, like those investors have to be in the best performing names to earn returns. So, I think if you have a shot at that, there's a willingness to fund, but I do think some areas are, in the private markets, I would be much more concerned about. I don't see that in the public markets. The public markets have been through this. There's not froth. Everyone thinks there's better returns elsewhere. That's good. It keeps expectations, at levels where, you don't run into problems. No, I don't think we would have a recession without the AI spend. In the first 9 months of 2025, it was 1 point of GDP, and real GDP growth was 2.5%. So it was material. It materially helped everything. It helped the economy. But even if you exclude it, again, you can't really do the math like that, but because there are knock-on effects. But even if you excluded it all, which assumes they wouldn't spend on other things and invest, you still would have a growing economy, although it'd be much, much slower growth. You'd probably have much lower rates. You'd have lower inflation. And then, was that all the questions? Oh, the valuations.
Yes.
Again, in the private markets, I do see some crazy valuations, and you now have companies that are large enough that they could be public, so you can compare them to, some public companies. Again, in the public markets, you really, at least in the AI space, there's enough concern that you don't see that. And again, the leaders like NVIDIA is barely above a market multiple, growing at 60% and accelerating growth. That's very, very, very unusual. There's a lot of concern about the durability of those earnings. Meta's trading at a discount, to the market. Now everyone's piled in Google because it's done well, but it's only trading at 30 times. So it's not insane. Now there are insane, it's more like the quantum stocks and the nuclear stocks where it's more lottery ticket-esque and driven by, some retail trading, and it's very disconnected from, the fundamentals. But broadly, I do not see that in the public markets.
Okay, so we're gonna go through two lightning rounds since we're coming up close on an hour. The first one, there's a few questions that we've gotten on in terms of the firm, and the second one is to go through some of the most talked about or questioned companies that we own. So just quickly, would you say your management style is more value, growth, or tactical?
We are value. As Buffett says, growth is an input in the value equation. And so we do consider growth because it's super important to what the intrinsic value of the business is. But growth managers only invest in companies that are growing above a certain rate. We don't care. I do think companies that are shrinking, that presents certain risks. And I typically don't like those companies because of the risk. But we're looking at what's the, company worth and where is it trading? Where's that disconnect the greatest? So we are value.
Do you underperform the benchmark index when financial markets are highly volatile or experiencing sector rotation?
Not necessarily. I mean, it all depends. I don't think you can make that connection that clearly. We underperformed in 2022, and the main reasons for that were, one, people feared a recession, and so our cyclical value names did poorly. Now they've all fully recovered since then. And then it was the popping of the innovative disruption bubble, and so early stage companies did very poorly, and we own those companies. And given how well they had done in 2020, the weight there was higher than it normally would be. And so I think we've made some changes to our process to, one, better identify bubbles, to avoid that eventuality. Two, to focus more. We're still doing long-term 10-year discounted cash flows, but we try to ground that in reality with a 5-year look on the fundamentals, which I think would have helped us with some of the names that we got wrong, during that period. But now I think the market was down year to date through Tuesday, and we were up. And in the early part of December, when the market was down, we were outperforming. So I think the portfolio, how we have it constructed now, I think we're well positioned, for downside scenarios.
Would you consider the strategy to be a good core holding in an IRA?
I think that depends on the time horizon. So, if you have a long-term time horizon, I think it's an excellent holding. The fund makes up 100% of my 401k, which is my retirement funds, which, that time horizon is shortening all the time, but I still got 20, hopefully-ish. So that's long enough. And again, I'm, like I said, it's fully invested in our funds. Now, if you need the capital in 3 to 5 years, I would be more conservative. I mean, anywhere you need capital in 3 to 5 years, I would always be more conservative with the positioning. I mean, some administrators like to not have anything with high volatility, in those kind of accounts because of their legal risk. That if you go through a down cycle and then it brings all your numbers down, and then you invite lawsuits. Again, I think that's flawed, because I think if you have a long-term time horizon, you can take more volatility to earn more upside. Not that there's no clear relationship there, but I just think that people overall are way too sensitive to volatility.
Now, probably on everyone's favorite part, the company questions. We're going to try to get through these. So starting with Citigroup, is the stock and other banks overpriced now? Should we be selling?
I still really like Citigroup, and we have not really lightened up Citigroup at all. Some of the other banks, I do think are, closer to certainly fair value, maybe a little overvalued. We exited our JP Morgan last year after owning it for over a decade. We also exited Bank of America. But Citigroup, I still think, has a lot of upside. They're still, they're having nice progress on the turnaround, and I still think there's a lot more to go there. So, today it closed at 115.66. Again, we think in 5 years they can grow the tangible book value from, roughly $100 today to, $150, and, improve the return on tangible common equity to 13%, have $18 in earnings. Again, if you look at, where names like that trade, it implies a stock price of, $270. So that would more than double again over the next 5 years as they continue to, improve the returns on the business. So I still think that one's very attractive.
All right, you mentioned Precigen earlier. It was our top contributor for the full year. We've owned it a long time. Can you just update us on your current thinking?
Yes, we still own Precigen. We have cut some of it back because it became a huge position, and it's still an early stage biotech, that's, higher risk. But I still think, they're making nice progress on commercialization of Papzimeos, which is their respiratory papillomatosis drug. They're getting good insurance coverage. We're still very early in that. But we think, that indication alone is worth $8 to $10 a share. The stock's trading at close today at 484. They also have a pipeline, early stage assets, but we think those are very attractive. So, but they're more binary, they're much higher risk. So we still think there's nice upside within the respiratory papillomatosis indication. If you add on value for the rest of the pipeline, the upside becomes quite significant. But again, it is a higher risk, higher reward type play.
QXO, that's a name we talked about last quarter, recently with Apollo's investment. Curious your thinking on the investment as well as our position in it.
So we did participate in, the Apollo deal that they upsized and came to market with. We thought that was an attractive structure. It's a preferred, a convertible preferred. They also did an equity raise subsequent to that deal. So it looks like they're getting close to doing a big deal. And I think the market, Brad Jacobs, who is the CEO, has an amazing track record. He's one of the savviest business people and capital markets people that I've ever met. And so, I have confidence that if he does a deal, it will be a good deal, and the market will probably get really excited because then it can look at, okay, what are the earnings of this business? What can we expect? And, when they announced the Beacon deal, the stock popped. I wouldn't be surprised to see that, happen again. Again, I think here there's still over the long term, a lot of upside potential as he goes about rolling up the building products industry.
Norwegian Cruise Lines, you've mentioned it as still attractive here. Someone wants to know if lower rates will be a tailwind for them.
I mean, anything that helps the economy and the consumer is good for, consumer discretionary and travel sort of companies. So I think it would help in that respect. Norwegian is still highly levered. They have some very attractive export credit financing agreements on their ships. They do have some floating rate debt. So some of that's based in euros, some of it's, in the US, but there would be a direct, boost from that. I think there's still a lot of pessimism baked into Norwegian. So I think anything, that improves confidence, as we get through the first quarter, as they, have grown their Caribbean capacity a lot. If they can meet their metrics through the first quarter, I think the stock should do extremely well. If they get a little bumpiness, I won't be concerned because they're gonna, roll out later this year, their new water park that's way better than anything, their private island in the area. So yes, lower rates could be a tailwind. I think the most direct impact will be on the consumer.
United Health, it's a name that we bought at really attractive prices. We've seen a bounce, but how are you thinking about it now? We're seeing rising costs. We have headlines with management and ongoing investigations.
Yeah, I mean, I think all that was in the price, I think was discounted in the price. And, we were aware of all that when we bought it. Again, I think the It's what we call the return of the king, when an old, proven, great CEO comes back, and that's what we had here with Steve Helmsley, and he, is making all the right moves. The increasing costs is an industry-wide cycle issue, and they'll reprice the business. A lot of that they can do over a year. Some of it'll take a little bit longer, to reprice and get pricing up. But that's easily resolvable if you have patience. They won't necessarily reach historical peaks, but you don't need to believe that they will at these levels. The investigations, again, the worst case scenario is very bad. They could be precluded from the market. That never really happens, and I don't think that will happen here. So, the recent Senate report said they had aggressive business tactics. Again, whatever that means, it's not illegal business tactics. So, again, I think at these levels, the risks are fully discounted, and it's a great company. That, again, I think they kitchen sinked earnings and should have a nice growth path from here.
And the last question, everyone's favorite topic, we can't ever have a call without talking about it, Bitcoin. Wanting to understand how you think about correlations and volatility as it evolves over time and as adoption increases.
Yeah, well, so it's had a sell-off. The high was 126,000. I think the low was 80,000. Now it's at 89,000. So the peak to trough sell-off so far has been 37%. Again, if the low is in, that will be, a much smaller sell-off each successive time, which is what we've seen with Bitcoin. Over time, the volatility has come down, and as adoption continues to increase, I would expect that to mostly continue. We still think of it as digital gold. It is, an alternative to the dollar, although, people have to go out on the perceived risk curve to take that ownership. I think if you look at gold, and the market cap of gold, that implies a $1.4 million plus price over some long horizon, call it a decade. That's a lot of upside in Bitcoin. Brian Armstrong, the CEO of Coinbase, said yesterday he thought it could reach 1 million by 2030. Again, no one knows, but and he said people should have 5% of their net worth in it. And he cited the same thing that Bill has cited, which is the supply of Bitcoin is capped. And so it cannot grow. And when people worry about, debasement and inflation, you don't have those dynamics with Bitcoin. And it is, its acceptance continues to grow, which I think gives it, a certain amount of appeal.
Thanks, Sam. But that closes it for today. As noted, any questions we did not get to, we will follow up personally with answers. And I'll hand it back to Sam.
Great. Thank you. Thank you, Christy. Thank you, Rebecca. I want to thank everyone for joining us. I think we have probably the best clients in the business, and we thank you so much for your support, for your interest. If there's anything that we can do to help you, please reach out to us. So I hope you all have a good evening.